Hello, everyone. Welcome to the weekly roundup. Today we'll cover tariffs, interest rates, and earnings releases. Hello, Ben.
Hey, Eva,
How's it going?
it's going good.
So, I'm not
And
going to talk about the weather today because we jinxed it last week. So, we're just going to go right into my questions.
I think
No
that's a
weather
good
talk.
call. Okay, I think that's a good call.
Okay, so starting off with the U.S. Supreme Court's decision to strike down President Trump's sweeping tariff. What does this mean for inflation, financial markets? Who stands to benefit from potential refunds? And what could he do next?
I think that's a great place to start because I think the market's trying to figure that out as well. So since that announcement's come out, we've had quite a bit of volatility. It's been an earnings week as well in the US and some of the Canadian banks report as well. So yeah, the market's trying to figure that out too. I think if you listen to what most of the leaders, senior leaders around the world are saying, seem to want to lean towards like what's paid is paid. Let's drive on without them.
Start
Not
over.
sure. Yeah, hopefully. So I think we're into the next round of negotiations, unfortunately, which is uncertainty. And the market hates uncertainty. So I think all those deals that he did around the world, every single leader in those countries have effectively said, like, this is not worth the paper it's written on now that these tariffs don't exist, or we don't have to enforce these tariffs anymore or pay them. Um, I think it's a real murky point for the judicial system in the US. It's a huge win. But as for what happens next, effectively he said, I don't care. Those don't matter. I'll just put in new tariffs. Well, it's the same thing. You can't do that. So um, refunds, I think, would be obviously a huge positive, big surprise news to the upside for all of the companies and countries that paid those tariffs, and a relatively large negative for the US. So probably good for capital markets, weaker US dollar, some of those things that would be positive for the markets. But I think where do we go from here? It's the big question, and I don't really know that there's a simple answer yet. But I do think going forward, there's a much higher probability that these countries and companies just say, like, we're not going to pay it. Your court ruled, said we don't have to pay it. We don't have to be involved, and we're not obligated to do that anymore. So I think that it's going to be an interesting nuance, but the uncertainty of it, I don't love for sure because that results in, well, quite a bit more volatility in the world and markets. And since then, we had a bit of correction in gold and silver last week, and then today or this week it's been quite a bit more stable and stronger. And so the big question mark, it's going to be another year of this chaos, and maybe that he wants that going into midterms, but we'll see. To be determined.
So the fourth quarter US GDP came in at just about 1.4%. This was below expectations, but inflation remains stubborn.
Hmm.
So how do you see the Fed balancing the need to support growth against, the risk of persistent inflation?
Yeah, I think it's a conundrum for them. I think the Powell's going to just hang on as long as he can, and at least the market's pricing in here that he's not going to do anything till he's gone. So I'd say likely he's wants to hold the line so that for his legacy, honestly, more than anything. And that he wants to be the central banker that tamed inflation. So with that, I think that probably overrides his need to cut, which clearly needs to do, because the US economy is stalling, the US consumer continues to be under pressure, and the rates are just too high for the consumption right now. We got debt levels and credit card levels at all-time high. So these high rates are putting pressure on the US economy. US economy is, I don't know, 70-80% consumption, depending on how you look at the metrics. And so you need the consumer to be in good shape. So I'd lean towards the next Fed chair will likely cut interest rates quite dramatically. The if the new Fed chair that comes in, Warsh, is the one that's named for the spot. Seems like he doesn't want to expand the balance sheet, but it's okay with cutting rates. So, that's a bit of headwind, I think, for money supply, but a bit of a tailwind for the consumer. And that probably gives some bump to some of the consumer stocks and probably to bonds as well in that backdrop if rates come down on the front end, and even if he pushes rates down on the lower end as well. So ultimately, I think we'll probably in a wait and see until the new Fed chair's in.
Okay. So wrapping up with the Canadian banks reporting solid results. And what do these results tell us about the real economy and the health of the Canadian consumer?
Yeah, so I think that's a great question. As you look through the financials, and I try to be thoughtful around what and how they're reporting the numbers, and it seems like the biggest pop, we'll say, was from capital markets, which would be loan syndication, new issues, note issuances. Good markets obviously help the wealth management business as well. So that those were more positive things for them. If you read through some of the reports, they said they had like positive funding wins, which effectively means they charge people more. But so net interest margin was a little bit better, and net interest margin simply just means they borrow at one price and they lend at another price, and that's their spread pickup. So this net interest margin was positive for them again for the quarter. Um, I don't know that the health of the consumer in Canada is in great shape as well because we got similar metrics. And if you look on the other hand, which is the housing market is in a 6 month decline, maybe longer, depending at the city that you look at. So, if you look through the earnings numbers and the mortgages that the banks carry on their balance sheets, the positive that the analyst community might say is, loan to value is around 60% for most of the mortgages that the banks carry on the books. So that's really healthy. But we're seeing some other deterioration in the system. So I mean, banks had blowout quarter. Lots of positive things for them. I think going forward, we need to look at, what's the likely outcome for them? Where are they going to make the pickup? And so I'd be of the view that they're probably fairly valued at this point. And I think it's a key thing to pay attention to in Canada. What are financials doing? Dig into the numbers, which I have a bit more, and say what's the likelihood that they can continue to accelerate at this point. And I'd say they have a lot of sensitivity to real estate now and to the equity markets. And so Canadian equity markets had a great year last year, which was a boon for the banks as well.
Let's see the charts.
Great. All right. So we are recording this around 1 o'clock, February 26th, 2026. So anything that happens between now and next week at 1 o'clock, we'll update on then. But lots of things that I want to take you through today. And let's just start with this because we talked about this. Rates, Canada, US, and ECB. So this is interesting, and I think worthwhile to pay attention to here. We've seen quite a bit of ups and downs this year, as we did last year. And last year was one of the first years where I've seen this much. Where typically forward guidance is pretty stable as we move towards either cuts or holds. We usually know leading up to the time that there's going to be cuts or there's going to be an increase or a hold. But last year we had tons of chop, and we're starting this year off again like this as well. So if we look at Canada here, we've gone from zero probability of a cut this year. Now we're starting to see a creep up, where this is for the March meeting, which is coming up less than, I guess, about 3 weeks away. That we're starting to see a cut creep in, and that's a combination of economic numbers and employment, and inflation should come in for February, I believe. Should be soft based on last February, which was quite hot. So this will be quite key and important to watch. US, we were anticipating a number of cuts, two, three, four, five, maybe this year. That's gone a little bit more neutral based on your point earlier, Eva, of sticky inflation. So I think that number will be key to watch as well. And then as we look out into the ECB land, which was, again, no chances that they were going to cut. Now we're looking at potentially three cuts priced in the next 6 months. And so that these are a bit of a sign of what's happening in the global economy. And I think central banks generally, for as long as they've been around, have been trying to kind of smooth out economic activity and hopefully never see a recession. And so far they've been pretty good at doing that the last 10 years. Will they be able to sustain it? We'll see. But the aggressive cuts that are coming out are certainly part of that narrative. So I'd be watching this quite closely. Lots of data to come between now and the next meetings, but ECB looks like they're going to cut next week. Next one, net speculative positioning US 10-year. So this is the 10-year bond in the US. And so I watch and follow and talk about bonds all the time. And so I think even on the annual outlook, we talked about what's the one thing you should watch. And oftentimes I get that question, and it's not really a fair answer because you can never just watch one thing. But if I was watching one thing, I would say looking at what's happening to the 10-year bond right now is going to be quite important to see what's going on with the health of the underlying economy. And so we saw quite a big move up from 2020 to where we are today, where the 10-year had gotten down to, I don't know, something around 0.5% in the lows of COVID. And now we're up here to 4.43%. So this is a huge move in rates that we haven't seen for some time. And then if we look down here, this would be the speculative positioning. And so, as we see extensions to the upside, these would be sell signals. And then as we see extensions to the downside, like these little bottom peaks here, those would be buy signals. So speculative positioning continues to hover around plus or minus zero. And so I'd be watching these levels quite closely. I think my view, as most of think that rates come down on the longer end, based on the view that it reduces some pressure on not only the U.S. economy, but also on the U.S. consumer. And so I'd be watching these numbers quite closely as we move ahead. So last one is earnings, S&P earnings. So S&P earnings report sooner than the TSX. So TSX only about 48% reported so far for this quarter, but this is the S&P numbers. So I think it's always interesting to look at this. So 86% reported, 76 beat, 8% met, and 17 missed. And so what I like to obviously do through this period, and my view is not necessarily the view that fits you best, but I look at the ones of, okay, what are the sectors that missed? So if you look here, materials, 22%, industrial, 17. So pretty spread across the board where the misses were actually, which is interesting. And then energy and consumer staples, so those missed as well. And then year over year, I'd be looking at these numbers here as well, just to say, okay, is this systemic or is this maybe a one-off as we adjust this information technology? That's such a big percentage of the S&P right now. So that would be a key piece to look at. So 11% beat. So some of those areas or sorry, 11% miss, excuse me. Some areas within that sector, their stocks sold off and could present opportunities, like a Microsoft, for example, which is down about 25% year to date. And so you'd be looking at, how did they reset? What were they doing? What's the reason for the miss, and where is the money being spent in the next couple of quarters? So I think this is a great checklist report card, so to speak, to give you a sense of what's going on, because market prices are based on future expectations. And so if you can look ahead and say, okay, markets overreacted to the downside, but the forward guidance looks good because they're spending money on R&D for some future developments, that could be a good entry point for a stock that you want to buy. And as always, the opinions expressed do not necessarily reflect those National Bank Financial. I prepared this with the best of my judgments and abilities. Everyone's risk tolerance is unique and different. If you have any questions, certainly about anything we talk about in here, please reach out to Eva or I, and we're happy to address them or speak to your advisor. But thanks so much for listening and watching the charts of the day.
Thank you, Ben.
You're welcome.
So, what's on the agenda for next week?
Well, there was a couple things we didn't talk about AI, which I think maybe we'll bank for this week because there's so much to talk about there. Maybe we should do our own. I think we should do a standalone meeting around that. So maybe we'll plan for that. That's one which will continue to percolate in the background. The State of the Union this past week was interesting too, just to see if anything material comes out of that. They did announce a 401k matching, which I think was interesting to see how that gets implemented. So every worker in the US, whether they work for the federal government or not, will have up to $1,000 of matching in their 401k is what he's proposed. So I'd say that's a positive for the individuals, but that's actually a positive for the stock market as well, because really that ends up going into ETF and passive flows. So that's a significant amount of money that would flow into markets if they do that. So we'll be reading through and seeing if that is likely to get implemented or it's just an idea. And then we're coming into month end here. So we are a new month next week. March 2nd, I think, is on Monday. So as we get to the end of another month, quite a bit of chop. I'd be looking to see what's March going to bring for us. And a couple of rate announcements coming for the month. So I'd be watching the inflation and unemployment and GDP numbers.
Yeah. Yeah. We blinked and 2 months have passed.
In a heartbeat.
I know. Okay, thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeat newsletters will be in the caption of the video and in your email box if you're subscribed. For our clients, reach out to me if you have any questions or if you'd like to book a review meeting with Ben. Thank you for listening and enjoy the rest of your day. Bye.
Thanks, everybody. Bye.